Develop trade plans that attempt to align price and market action. That's what I want you to walk away with. All right, I'm going to use moving averages to differentiate between price and market. I'm going to use oscillators to differentiate price and market. We're also going to use Fibonacci, and we're also going to use pivot points. Fibonacci being sort of support and resistance, a leading indicator for price action, and pivot points, a leading indicator for market action. So I keep separating the two, but what you want to walk away with is the idea is to align both price and market for your best odds of success. Okay? Okay, lagging indicators. Lagging indicators study past data. All right, they do not predict the future. They've only told you, what has been happening. Okay, what you're looking for is a change. All right, you're setting up a trade plan, so you want to sort of predict the future, right? You're using this past information to look for a change, and then you can develop a trade plan around that change. So we'll look at moving averages and MACD for this. Okay. So just very quickly, so you can see the chart setup. I use speed, which is market. I measure the speed of the market with 2155. I use momentum for 5.8. That's all we're discussing today. And then down there at MACD, 2155.8. They're custom MACD settings. I'll explain that later. And stochastics, 835. Now, if you're looking on your list of indicators, it's not slow stochastics. There's fast Stokes. There's slow Stokes. This is the stochastic oscillator. Okay. Now this presentation will be made available on fxbootcamp.com and on moneyshow.com. So I'll get you these slides, okay? So you don't have to start memorizing this. Remember, don't memorize the numbers. The idea here is I'm trying to separate market action from price action. Let me explain that. Okay, the 2155, this represents the speed of the market. Okay? We're on slide 11. Speed of the market. The greater the angle of separation between these two moving averages, the greater the market is moving. So in this case, the 21's below the 55. The market's falling, right? That's all I want to see at this point. Okay? The market's falling. It's falling quite quickly. It's not even near the 21 in the beginning here. And the market's falling. Ideally what you want to do is then get your trades in that same direction. You don't want to trade against the market. You want to find the path of least resistance. You want to swim out into the middle of the river, float downstream in the current. You don't want to fight the current. It's more difficult to swim upstream. Okay? So that's the first thing I look at when I open my charts. What's the market doing? Then what I look at is the 5.8. This represents momentum. Okay? Momentum of price. So notice how price is falling, falling, falling just below that red EMA. That's the 5 EMA. That means the price is falling, and it's falling very quickly. You certainly don't want to go along in that situation. And then all of a sudden you see this. All of a sudden it's crossing all over each other. That's called braiding, like a young girl's hair, over and over and over again. That's a death trap. You want to lose money, start trading when you see that. Okay, you don't want to trade when that's happening. There's no momentum, so where do you expect price to go? Okay. Now I also use the 200 EMA for a long-term trend. It's just sort of a way to align the satellites, so to speak. I also use a volatility indicator, the Bollinger Bands. Okay, when the Bollinger Bands are wide, there's lots of volatility, lots of people are trading. If they're very narrow, creating a tunnel like this, it means nobody's trading. Again, another technical indicator to tell you to not pull the trigger. Just walk away. Walk away. Go for a walk, walk your dog, vacuum your carpet, do something, but don't trade. Okay, and then down below you'll see these oscillators we're going to talk about a little bit later. I'm just showing you how to understand the charts examples that I'm going to show you. Up top is MACD. I've slowed it down. Stochastics is on the bottom. I speed it up, and I'll go into more detail later. So that's what a chart would look like. Does that look confusing? Does that look like 1,000 different lines? Come on. Yeah, it's a lot. Really, you got to break it down into pieces.